I am delighted to welcome the distinguished dignitaries to the dais. Our chief guest, Shri Shaktikanta Das, Governor RBI, Shri M.V. Rao, Chairman IBA and MD and CEO Central Bank of India, Dr. Anish Shah, President FICCI and Group CEO and MD Mahindra Group, Shri C.S. Sethi, Chairman SBI, Shri Sunil Mehta, Chief Executive IBA, Shri Ruchin Goyal, MD and Senior Partner BCG, and Madam Jyoti Vij, Director General FICCI. Thank you, dignitaries. Namaskar, ladies and gentlemen. I am your host, Pooja, and a very warm welcome to all of you to the IBA FICCI Annual Banking Conference on the theme of Banking for a Viksit Bharat. Now, may I request Madam Jyoti Vij to kindly take over and moderate the inaugural session. Welcome, ma'am.
Good morning, everybody. A very warm welcome to all of you to this year's edition of the FICCI IBA Annual Banking Conference called FIBAC. The theme of the current year's edition is Banking for the Viksit Bharat. As we all know, that Viksit Bharat vision that has been envisaged and been a goal that has been set for ourselves would require adequate financing, and with banking being the dominating player in the financial ecosystem, it definitely has an extremely significant role to play in meeting the targeted development objectives. And of course, over the course of the next 2 days, we'll have an interesting lineup of sessions to discuss the future role of the banking to achieve these objectives as we go forward. So before we initiate the proceedings of the day, I would like to take the opportunity to extend a very warm welcome to the Honorable Governor, RBI, Shri Shaktikanta Das, for once again gracing the occasion and being with us. Truly honored, sir, to have you with us once again. May I also request Dr. Anish Shah, President FICCI, and Shri M.V. Rao, Chairman IBA, to welcome the Governor with a green certificate, which is a way of ecological way of welcoming you, sir. You are aware of the green certificate, which will be a plantation of trees in your name. May I now request Mr. M.V. Rao, Chairman IBA and MD and CEO Central Bank of India, for his welcome address.
Respected Sri Shaktikanta Das, Governor, Reserve Bank of India, Sri Anish Shah, President FICCI, Sri C.S. Sethi, Chairman, State Bank of India, Sri Sunil Mehta, Chief Executive IBA, Madam Jyoti Vij, Director General FICCI, Sri Ruchin Goyal, MD and Senior Partner BCG, and all participants. Good morning and very warm welcome to all of you to this annual conference of IBA and FICCI. This joint conference of two associations, one representing the corporate sector and the other representing the Atma of the Bharat, that is banking sector, under the brand name of FIBAC, is entering into its 19th year. For IBA and FICCI, it is a momentous occasion, and I am glad to note that this event has emerged as a flagship event which exhibits considerable interest among various stakeholders. Every year in FIBAC, we select a pertinent theme for the conference so that participants derive fresh ideas and thoughts at the end of the two-day deliberations. This year's FIBAC theme, Banking for Viksit Bharat, is quite significant in today's context and is linked to the growth aspirations of our nation to become a developed nation by 2047, that is 100th year of independence. It will require a unified effort across all sectors and role of technological innovations will be the key to achieve desired goal. In this endeavor, our priority should be to build an environment where financial services are efficiently accessible to the 1.4 billion people. From the mobile banking to digital payments, AI-driven lending, blockchain innovations, the ecosystem is constantly evolving to meet the diverse needs of growing economy. Digital technologies have been instrumental in expanding financial inclusion, improving efficiency, and enabling real-time services, whether it is UPI, that is Unified Payment Interface, or upcoming ULI, that is Unified Lending Interface, or in future, as a banker, we already have the framework for the Unified Balance Confirmation, which has to lead to the URI, that is Unified Recovery Interface. Many functions and operating models will have to be built as regulation, competition, and customer choices evolve rapidly while protecting customer data and ensuring privacy. Agility in providing access to cost-effective credit for unbanked and underbanked segments, robust and tech-enabled systems which are predictive, preventive, and responsive to manage traditional operational risk as well as new age risk. The two-day program of FIBAC covers almost all the priorities of banking sector and corporate sector. We have eminent panelists from industry, banks, consultants, financial institutions, and fintechs. I hope the deliberations from these panels and thoughts and ideas shared by experts would help the participants to collect guidance for building a roadmap and show our ability and commitments towards Viksit Bharat. I thank Sri Shaktikant Das, Governor RBI, for accepting our invitation to grace the occasion and deliver inaugural address. I wish you all the fruitful conference over the next 2 days. Thank you.
Thank you, sir, for your address. May I now invite President FICCI for his welcome address, please.
Sri Shaktikanta Das, Governor RBI, Sri M.V. Rao, Chairman IBA, Sri C.S. Sethi, Chairman State Bank of India, Sri Sunil Mehta, Chief Executive IBA, Jyoti Vij, Director General FICCI, and Ruchir Goel, Senior Partner and MD, PCG. Distinguished ladies and gentlemen, this is such a wonderful conference that was set up almost 20 years ago and brings together the banking sector and industry to deliberate on issues that are required to take India to the next level. And there's no better time than today to be here, because where we stand is at the cusp of an inflection which will put India in a different orbit. I'd like to start by complimenting the Reserve Bank of India on behalf of industry for ensuring that the economy has stayed stable through multiple problems and challenges that the world has seen over the last 5 years. There were a number of steps taken proactively, the most recent being steps to prevent inflation from becoming rampant in India, as we've seen in some parts of the world, and that helped us keep interest rates relatively stable. We didn't have to go up as high as many other parts of the world did. That allows us to set the foundation for growth for the future. Our Prime Minister has talked about Viksit Bharat and the fact that we should reach a $30 trillion economy by 2047. What does that mean? From a manufacturing perspective, manufacturing needs to be 25%, up from 16% today. And that means that manufacturing has to grow 16x in the next 23 years. These are not numbers for the faint-hearted. 16x over the next 23 years. And how do we collectively make it happen? In a world that is changing rapidly, and that's where, again, we have the tools to be able to get there. The digital tools that India has set up are essential to get there. But so is a mindset for change. The mindset to be able to look at things that are coming up in a much newer way and be able to take them and take them forward. The mindset to maybe underwrite differently, to help our MSMEs to underwrite with cash flows rather than collateral, to look at newer areas such as electric vehicles. And yes, there are challenges because we don't have established residual values, but how do we end up making that area a success? And there are a number of other things that will change, but how do we as bankers and industry professionals work together to make Viksit Bharat a reality? At FICCI, we have outlined 4 key priorities for the year. The first is Make in India. If manufacturing has to grow 16x in the next 23 years, it cannot be just serving manufacturing for India. It has to be Make in India for the world. For that, we have to be the lowest cost destination for manufacturing. A number of actions have been taken to make business easier, but there have to be more. Infrastructure has to be at a different level. And these are various actions that FICCI is taking, working with the government, working with industry to identify ideas as to how do we make this possible. The second is women-led development. Women today are not equal in the workforce. And we should have equality in every way. If we want to be Viksit Bharat, that is essential for us. And therefore, how do we create that empowerment? How do we create that equality? And here again, there are a number of activities that are being undertaken to be able to accelerate that journey. The third is farm prosperity, because agriculture will continue to be a major area of focus for us. And there are a number of initiatives there that will help increase productivity in agriculture. And the fourth is sustainability. The impact that we see on our planet today will continue unabated unless we take specific actions on that front. And that, therefore, is an important area for India to take the lead in the world. So we stand today at a place which is an exciting one which holds a lot of promise for the future. And that is a context that we together can make a difference. Thank you.
Thank you, President, for highlighting the 4 priority areas that we have picked up and how they can contribute, therefore, to the Viksit Bharat mission and the funding that could really play a very significant role. We now move on to releasing this year's knowledge report on the theme, which is Banking for Viksit Bharat. May I request RBI Governor Shri Shaktikant Das Ji to kindly launch the knowledge report. I request the team to kindly present it. So the report highlights 5 important structural themes for the banking sector, which is the deposits, the asset quality, productivity, digital maturity, and future capabilities that need to be worked upon going ahead. This has obviously been done in the view of the $30 trillion GDP ambition that we have set for ourselves for the year 2047, and will require 20 times growth in the financial services sector, with banks, of course, playing a pivotal role. May I now invite Mr. Ruchin Goel, Managing Director and Senior Partner, BCG, to make a presentation on the report and an acknowledgement of the knowledge partnership that we have had with BCG for several years. Thank you.
Thank you, Jyoti. Respected dignitaries, ladies and gentlemen, it's my absolute pleasure and honor to share the key findings of this year's FIBAC report titled Banking for Viksit Bharat. Our government has set a very long-term and a very bold ambition for all of us to become a Viksit Bharat by the 100th year of our independence. This would mean our GDP to grow from 3.5 trillion to about 30 trillion in the next 23 years. As we are all aware, financial services sector in general, but banking in particular, plays a very pivotal multiplier role in the economy. And for the GDP to grow 9 times, our banking sector will have to grow almost 15 times. This will require a massive $1.5 trillion of fresh capital inflows in the banking sector. Now, this can only happen if we have a banking sector that is stable, resilient, and profitable. Currently, our banking sector is the envy of the entire world. Despite a large number of challenges in the recent past, our banking sector exhibits very healthy levels of profitability, capital adequacy, and valuations. However, we cannot take this for granted. There are increasingly newer and newer risks coming up and newer challenges coming up. And the report actually talks about 5 key structural themes that banks will have to address in order to fulfill our aspiration of being a Viksit Bharat. We have seen massive adoption of digital in the banking sector. Not just number of transactions that you see on this chart, growing to almost 95% being digital. We are also increasingly seeing sales and services being digital. But despite the massive push on digital, we are seeing that the costs in the banking sector are actually rising faster than income. And what that leads to is that the cost-income ratio for the entire industry has gone up from around 45% 10 years back to 50% currently. As you will see on this chart, the largest contributor of cost is technology. And going forward, as banks embrace newer technologies, as the regulatory costs keep going up, when banks are trying to protect their balance sheets, the pressure on costs will continue. Banks will have to really boldly think about reimagining their entire operating model to break this sticky cost structure. This is paramount for banks to remain profitable and be able to attract the capital that I just talked about in the previous page. We are also seeing massive changes in the way households are saving. Although the overall saving rates are roughly similar in the last decade, what is happening is households are putting increasingly more and more money in capital markets, in pension funds, in other forms of areas outside of bank deposits. Households are also increasingly borrowing from banks, and as a result, households have turned net borrowers from banks. Now, this is not unique to India. It happens in many other parts of the world. But what is different is that India does not have a well-developed capital markets today. So a lot of money that flows into capital markets does not find its way back into financing debt for individuals, MSMEs, and for corporates. Now, this is a structural challenge and has to be addressed. Banks will have to innovate and market their deposit products better. Government and regulators can also help banks to try and give them some relief to attract more resources for the sector. India has also seen very rapid growth of retail credit. In particular, the unsecured credit has grown quite fast. As you will see on this chart, the penetration of unsecured credit at about 6.5% in India is almost at the same level as what we see in many developed markets like US and UK. Our report also highlights some pockets of leverage buildup and also incidents of frauds going up. And hence, these concerns were picked up by RBI, and RBI has taken some corrective actions to try and address these issues. However, if you look at another metric, if you look at the number of unsecured loans to total working age population, India is still very far behind. Only about 9% of working age population in India have access to formal credit. Also, what we are seeing is the percentage of loans being given to new to credit, people who do not have any loans from the formal sector, is coming down. Only 10% of loans being given are to people that are new to credit. At this rate, we cannot become Viksit Bharat. And hence, our report argues that India will have to chart its own course. We cannot copy what happened in the more developed markets, where unsecured credit is very important, because 90% of people who do not have access to credit, if they have to start taking up formal credit, it's unlikely they'll start from a secured credit. They will start from a small ticket unsecured credit. So banks will have to find a way to keep the balance of finding ways to lend to this sector that is still stable and profitable for the entire sector. Now moving on to MSMEs, we are seeing massive formalization of the entire MSME sector, with many more MSMEs having Udyam registration, GST registration, and also QR codes. With the push from the government, we are also seeing a very large increase in the number of MSME loans being given out, and about 35 to 40% of all these loans are new to credit. However, MSME underwriting is complex, and what we are seeing is, if you take the portfolio quality, there is a very large variation between the top quartile and the bottom quartile banks. So banks will have to really embrace the power of the entire ecosystem of digital data that is being available for MSMEs to reimagine the way MSME lending is done, so that the lending that is being done is sustainable and profitable for the whole sector. The report also talks about 4 key capabilities that banks will have to embrace on technology and operations resilience, on digital and AI, ESG, and cybersecurity. In summary, the report talks about 5 key action agenda for the banks that I've just highlighted. And beyond banks, the report also highlights a 7-point action agenda, both for the regulator and for the government. Now, India has really benefited from our regulator and the government being very bold and innovative. And our report talks about what else can be done. For example, RBI can really lead the way in embracing the power of AI by using AI on its own supervision department. RBI can also, embrace many more public utilities in the areas of climate, cyber, and fraud risks. This can further strengthen the entire banking ecosystem. On the part of government, the government can continue to promote consolidation of banks so that we can have larger and bigger banks who can invest in the newer capabilities that are required. Government can also promote further digitization of land records and deepening of capital markets. To conclude, I quote Robert Frost, "The woods are lovely, dark and deep, but I have promises to keep, and miles to go before I sleep, and miles to go before I sleep." We all have miles to go before we can attain the promise of Viksit Bharat. Thank you.
Thanks, Ruchin. This is a structured plan in the knowledge report that's been highlighted on what needs to be done in the banking sector by various players to meet the Viksit Bharat goal. We now, of course, have the pleasure to invite our Chief Guest, Sri Shaktikant Das Ji, the Governor RBI, for the inaugural address. As Governor RBI, he's had impeccable record of meeting every challenge with his depth, skill, and leadership, including the COVID times that we all saw. His presence gives us much comfort to all that the management of our economy and financial sector, that it is all in the right hands. Also, the Governor has been rated A+, as we all know, in the Global Finance Central Banker Report Cards 2024 for the 2nd consecutive year. Many congratulations, sir, for this feat. And this is the recognition of your leadership and work towards ensuring economic stability. Many thanks, sir, for joining us once again today, and may I request everyone to please welcome him with a round of applause as I invite him to please deliver his inaugural address.
Good morning, namaskar. Dr. Anisha, President FICCI, Sri M.V. Rao, Chairman IBA, Sri Sunil Mehta, CEO IBA, Chief Executive IBA, Ms. Jyoti Vij, DG FICCI, Sri Ruchin Goyal from BCG, members of FICCI, IBA, distinguished guests, members of the media, ladies and gentlemen. I'm extremely delighted to be back at the FIBAC annual conference. This conference is special as it brings together industry players, financial sector players, regulators on a single platform to discuss vital issues of contemporary relevance. So if we are looking at the industry and business sector and the financial sector, including the regulators and other authorities, I think almost every segment is represented here through their representatives and through their leadership. I would like to congratulate the FICCI and the IBA for organizing this annual conference, which is unique in its own way. The Indian economy is now at a critical juncture. Massive changes are taking shape in various economic sectors and markets, and the country is geared for orbital shifts. Our nation's journey towards becoming an advanced economy is drawing strength from a unique blend of factors, and these factors would include a young and a dynamic population, a resilient and diverse economy, robust democracy, and a rich tradition of entrepreneurship and innovation. In this background, I have chosen to speak on the topic India at an inflection point, some thoughts. I have structured my talk under 4 major themes. First, I would like to speak on India's growth prospects and the approach we need to follow going forward. Second, I would like to dwell upon recent developments in inflation and monetary policy. Third, I propose to highlight certain issues relating to strengthening of our financial sector. And finally, I would spell out certain expectations from the financial sector. Let me first touch upon the growth prospects of India. Much has been talked about it, much has been discussed about it. Various authorities have been giving out various numbers. So it is necessary to cut out the noise and to sort of exactly analyze where India's growth story stands and what is the outlook forward. The Indian economy, as all of you would know, rebounded strongly from the COVID-19 induced contraction, growing at an impressive annual average of 8.3% in the last 3 years. For the current financial year, the Reserve Bank has projected a growth rate of 7.2%. The IMF has also projected India's growth prospect. They have in fact revised their growth projection for India upwards and have now placed it at 7%. And 2 days ago, the World Bank has also upgraded India's growth forecast to 7% for the financial year 24-25. So as you can see, I think the projections made by all the agencies, international agencies, as well as the Reserve Bank, I think our perceptions and projections are converging. The National Statistics Office, that is the NSO, has placed India's GDP growth at 6.7% in the first quarter of this year. Now, naturally, that has raised some discussion and about whether the 7.2% projected by the Reserve Bank would actually materialize or not. Now, let me clarify and let me explain this entire aspect in slightly, in some detail. Now, notwithstanding the moderation in growth from the previous quarter and being below our projection in Q1, the Reserve Bank had projected 7.1%. The actual growth number has come to 6.7%. Now, the data actually shows that the fundamental growth drivers of the Indian economy are actually gaining momentum. They are not slowing, they are gaining momentum. This gives us the confidence to say, that Indian growth story remains intact. And I would like to emphasize this point. Private consumption, which is the mainstay of aggregate demand, with a share of around 56% of GDP. 56% of the GDP is attributed to or comes from private consumption. Now that has grown at a rate of, in fact, that has rebounded to 7.4% growth from a very feeble 4% growth in the second half of the previous year. That is 23-24 in the second half. Private consumption grew by 4%. First quarter of this year, private consumption has grown by 7.4%. This reconfirms the revival of rural demand. FMCG players, FMCG companies, if you talk to them, I mean, the data which comes out shows that clearly the rural demand is picking up and has picked up. The other important driver of growth, now apart from consumption, which accounts for 56% of the GDP, the other important driver of growth is investment, which accounts for 35% of GDP. Now, investment has grown at 7.5%, keeping with the recent momentum. So more than 90% of the GDP, that is private consumption 56% and 35% coming from investment. You know, these are the drivers of the GDP calculation. Now more than 90% of the GDP expanded at a robust pace and materially above 7%. The headline number, however, came lower against the backdrop of muted government expenditure of both the center and the states, perhaps due to the elections. Excluding government consumption expenditure, GDP growth would have worked out or works out to 7.4%. Now, I don't want to get too much confined into these numbers, but I think it's when we talk that first quarter GDP has slowed down to 6.7%, we have to take note of that. We should not brush it aside. But at the same time, it is essential to analyze carefully actually from where where exactly the growth has slightly moderated, or which has actually, which has had a moderating influence on the growth, and to deal with that particular segment, while of course not losing focus of the other growth drivers. Now these are from the demand side, investment and consumption. From the supply side, while agriculture grew modestly at 2% in the first quarter, it is likely to perform better in the remaining months of the current year on the back of good progress of monsoon, good sowing of kharif crops, and good moisture conditions for the next rabi crop. Industry and services, which are also important components of the supply side factors which impact our growth. Industry and services recorded a growth of 7.4% and 7.7% respectively. Industry grew at 7.4%, services grew at 7.7% in the first quarter. Now they underscore the continued strength in economic activity. Construction activity, which is a very important segment of any growth assessment. Construction activity remained robust, growing at 10.5%. Now, according to the Reserve Bank's latest data, bank credit to agriculture and allied activities remained robust and increased by 18.1% year on year. Credit to industry increased by 10.2% year on year in July this year, as compared to 4.6% in July 2023. Within industry, credit to MSMEs, and as you know, MSMEs are an important component of our economy. Within industry, credit to MSMEs also grew at 14.4% year on year. Bank credit to industries such as chemicals, chemical products, food processing, petroleum, coal products, and nuclear fuels and infrastructure has been quite strong till July 24. The enhanced credit flow to industry, along with an all-time high capacity utilization in the manufacturing sector capacity utilization is at 76%, which we gave out this number in the last MPC statement. Now, the enhanced credit flow to industry, along with an all-time high capacity utilization, points to an upturn in investment cycle as reflected in the NSO data. It is evident that India is on a sustainable growth path. Consumption and investment demand, as I said, the two main drivers of growth are growing in tandem. Government expenditure of the center and the states is likely to pick up pace in line with the respective budget estimates in the remaining quarters of the current year. Strong balance sheets of banks and corporates have created congenial conditions for further support of capital expenditure. Corporate profits, net, that is net corporate profits, have grown by 14.2% in the first quarter of 24-25. This we have give out, in fact, this is based on Reserve Bank survey of 2,934 private non-financial corporates. Now, this data was released very recently by the Reserve Bank. It is there in our website. I have given a reference to this in the footnote of my address, and this particular address will be uploaded in the Reserve Bank website, so you can have a look at it. So therefore, Reserve Bank survey of 2,934 listed private non-financial corporates have shown that their net profit in the first quarter have grown by 14.2%. So considering all these factors and also the fact that the budget provision, the government capital expenditure provisions in the current budget, in the current year's budget are also robust, taking into account all these factors, overall, I would therefore like to say that the Reserve Bank's projection of GDP growth at 7.2% for the current financial year 24-25 does not appear out of place. As regards growth prospects in medium to long term, it is felt that Indian economy is on the cusp of transformational shifts. The fact that growth is on a rising trend, despite modest global growth and continuing global challenges, shows that structural drivers are playing a bigger role in India's macroeconomic outcomes. I would like to repeat, I would like to read this sentence again. All these things show that structural drivers are playing a bigger role in India's macroeconomic outcomes. These drivers would include policy push on creating robust physical infrastructure, our fast-growing digital public infrastructure, innovation and technological advancements across sectors, and critical reforms in key areas. To realize this aspiration of transitioning from an emerging to an advanced economy by 2047, the Indian economy would need a multi-pronged and multi-sectoral approach. Our focus should be on employing all engines of growth from both supply and demand sides. The supply side focus must encompass agriculture, industry, and services. We should be mindful of the fact that agriculture possesses huge potential in India, and agricultural activities in horticulture, edible oil, dairy, poultry, food processing, etc. could indeed be the focus areas. And these are areas which have the potential to create additional employment in large numbers. Our approach should be to enhance productivity as well as quality of our produce so that we gain a significant share in world exports while meeting our domestic requirements. The potential contribution of manufacturing will be pivotal to generate additional employment. Initiatives such as Make in India, Startup India, One District, One Product, and Production Linked Incentive, that is PLI scheme, among others, are helping the manufacturing sector gain competitiveness and grow faster. The MSME sector in particular holds a lot of promise to step up growth and employment opportunities. Overall, the manufacturing sector must take the lead in niche areas to compete globally. The services sector, which has remained the mainstay of growth over the last several decades, must explore new vistas of opportunities with focus on higher value-added services. In addition, requisite focus on research and development, that is R&D, is also vital for productivity and competitiveness. Together with government initiatives, including the announcement and the setting up of R&D fund, the private sector may also be an active partner in this field. As I stated earlier, key demand drivers like consumption and investment and exports of goods and services will have to move in tandem. Higher domestic consumption would help to insulate our economy from the vagaries of external uncertainties. Investment remains critical for sustainable growth of the economy, and given the current confluence of favorable factors, it is time for the private corporate sector to also come forward in a big way. There are signs of private sector investment happening in a number of sectors, as I listed out, but I think the scope can be more, and it is for the private sector players to really take their own call. I'm no one to give advice on this issue, but from a regulator's perspective and from the perspective of where our economy stands, from the perspective of the opportunities that lie ahead, from the perspective of the outlook that we have ahead of us, I think it is time also for the private sector to ponder, to consider, and step up their investment in their respective businesses. The potential of external demand can be utilized to our advantage by getting integrated into global supply chains. This is one issue which has been talked about quite a lot, but I think industry players together with financial sector players, we and the various authorities concerned, we all need to work together and strategize how to enable India to get into the global supply chains is with a much bigger share in the global supply chain, in the entire global supply chain universe. A holistic approach to nurture and accelerate broad-based growth of the economy would also necessitate preservation of the gains of past reforms and accelerating India's reform journey with more reforms. I repeat, a holistic approach to nurture and accelerate a broad-based growth of the economy would also necessitate preservation of gains of past reforms and accelerating India's reform journey with more reforms. From an economic perspective, reforms that have imparted paradigm shifts and buttressed our stability and growth story would include, and I have listed 6 of them, there are many more, but I have listed 6 major reforms which have indeed resulted in a paradigm shift and which have really sort of given the necessary push to strengthening our economy and to take it to the next level of development. And these 6 reforms, apart from others of course, which I have listed, these 6 would include, number 1, shifting from administered exchange rate of the rupee to a market-determined regime. Number 2, stoppage of automatic monetization of budget deficit financing by the Reserve Bank. Number 3, enactment of the FRBM Act. Number 4, introduction of the flexible inflation targeting framework. Number 5, enactment of the Insolvency and Bankruptcy Code. And number 6, implementation of the Goods and Services Tax, that is GST. Each of these 6 reforms have yielded long-term positive outcomes. These reforms need to be augmented by reforms in land, labor, and agricultural markets. While we have made some progress in these areas, lot more needs to be done both at the national and subnational levels. Improvements in ease of doing business, especially at local levels, will go a long way in boosting our competitiveness. Now, after highlighting on these growth aspects and the growth story, the second area which I would like to highlight is on inflation and monetary policy. In early 2022, The flare-up in food, commodity, and energy prices following the outbreak of the war in Ukraine led to a sharp increase in inflation. This was further compounded by a series of adverse domestic shocks. The decisive steps taken by the Reserve Bank, together with the supply-side measures from the government and the cooling of international commodity prices, have led to a downward shift in inflation from early 23-24, that is from the early part of the financial year 23-24. Nevertheless, the pace of disinflation is frequently interrupted by volatile and elevated food inflation. It is the headline inflation that matters. It is the headline inflation, with food inflation having a weight of 46% in the headline inflation, which the people understand. With the monsoon progressing well and the healthy kharif sowing raising prospects of better harvest, there is greater optimism now that food inflation outlook could become more favorable during the course of the year. However, I must add and emphasize that we have to remain watchful of how the forces impacting inflation play out. The balance between inflation and growth is now well poised. The balance between inflation and growth is well poised. You know, our monetary policy, the legal framework which the enactment in the Reserve Bank of India Act has mandated the Reserve Bank to achieve, is to maintain price stability, which is defined in terms of maintaining inflation at 4% with a tolerance band of 2% on either side. That is, it should remain between 2 to 6%, but the target is 4%. So the mandate given to the Reserve Bank under the Reserve Bank of India Act is to maintain price stability defined in terms of 4% target plus minus 2%, while keeping in mind the requirements of growth, while keeping in mind the objective of growth. So from that perspective, I would like to say that our analysis shows that at the current juncture, and also based on our outlook, the balance between inflation and growth is well poised. We must successfully navigate the last mile of disinflation and preserve the credibility of flexible inflation targeting framework, which is a major structural reform. The best contribution that monetary policy can make for sustainable growth is to maintain price stability. I would now like to turn to the third component of what I wanted to say, that relates to financial sector, strengthening the foundations for the future. India's financial sector has repeatedly demonstrated its ability to overcome challenges and crises. As a regulator, we have done our best during successive global shocks which the Indian economy faced, along with so many other countries. And I must mention here that it was ultimately the joint effort, it was ultimately the cooperation between the Reserve Bank as a regulator and the financial sector players like the banks, the NBFCs, and other financial sector players. It is this active cooperation and it is this open door communication between us during these periods of successive shocks which has enabled our country to be where it is today in terms of financial stability. So the financial sector has repeatedly demonstrated its ability to overcome the challenges and the successive shocks from various global factors. The financial sector showed remarkable resilience during the COVID and also in the aftermath of the COVID-19 pandemic. Today, all key indicators of the financial sector demonstrate robust health. This resilience, combined with other forces, can act as critical driving forces for India's future. In this milieu, financial sector needs to even further deepen financial inclusion, broaden access to credit and other financial products, and support overall inclusive growth. It also needs to drive innovation in digital banking, foster sustainable finance, and build robust financial ecosystem that can withstand emerging challenges and facilitate higher trajectory of growth. With the financial sector now in a strong position, it is our collective responsibility to safeguard this stability, especially in an environment of heightened global uncertainty. Financial institutions must continuously assess and refine their business models, recognize and deal with emerging risks, and remain focused on capitalizing on every new opportunity. This brings me to the important issue of inclusive growth. But before going into inclusive growth, I think it's a point which has already been touched upon by the previous speakers and by also the presentation that was made here. I think a key focus area, and I'm not saying anything new or which is not known, but I feel it is necessary to constantly, keep reminding ourselves that these should be our priority focus areas. I think we have to be also mindful of several non-financial risks. The financial sector, the financial parameters of the financial sector today are strong and robust, but we also should be mindful of the potential, the sources of, what you call non-financial risks, which may affect the financial sector. And in this, I would like to include elements like cybersecurity, managing third-party risks, managing spillovers from a rapidly changing global environment, managing and adopting new technology into our operations, into our business practices, and several such initiatives. At the Reserve Bank of India, we have been embracing technology, and we are trying to keep up ourselves with regard to utilizing technology, with regard to utilizing AI in our internal operations, whether it is supervision or in other areas. UPI is a great example about which the whole country can be proud of. As you are aware, central bank digital currency, that is CBDC, e-rupee, we are one of the, we are among the very few countries which are running pilots. I would also like to mention, we have already announced in public domain, that we are setting up a cloud facility for storage of financial sector data of all financial sector players. And this is something which will be of particular benefit to the smaller entities in the financial sector, whether they are small NBFCs or they are medium-sized NBFCs or small private banks, or for that matter, the urban cooperative banks. So we are working on the cloud facility. It is work in progress. We have announced, in the last week in a conference in Bangalore, I announced on behalf of the Reserve Bank of India the launching of the pilot for the Unified Lending Interface, ULI, and I had gone on to say that, as you know, JAM Trinity has been talked about a lot, but the new Trinity, which can really be a game changer for our progress in the years to come, will be the new Trinity of JAM, UPI, ULI. So, and as you may be aware, we have already given out an agenda for RBI at 100, where we want to see the Reserve Bank in its centenary year in 2035. So let me now turn to the issue of inclusive growth. While traditional metrics of economic growth like GDP and per capita GDP are important indicators of progress, they alone do not capture the full picture of what it means for a nation to be truly developed. India has made remarkable progress in extricating people out of poverty. A truly developed India must ensure that every citizen, regardless of their socio-economic status, has access to financial services and has the required financial literacy. By expanding access to banking, credit, and insurance, and by harnessing the power of digital platforms, the financial sector can drive inclusive growth that extends to the most marginalized sections of our society. The priority sector lending, that is the PSL program, remains crucial in addressing credit gaps for underserved segments. Introduction of business correspondents, that is the BC model, has further enhanced financial outreach. The Financial Inclusion Index introduced by the Reserve Bank of India has improved from 53.9 in 2021 to 64.2, reflecting to 64.2 in 2024. That is the data we released on March this year, reflecting the strides made in providing access to financial services. Now, while we have provided access to financial services, there is still more to be done to improve the usage and quality of these services. Two more key drivers need to be prioritized. Enhancing financial literacy and leveraging technology. The Reserve Bank has engaged in both self-driven and collaborative approaches to promote financial literacy. We run multimedia public awareness campaigns, outreach programs, as well as targeted financial literacy awareness programs. The banks, on their part, are also operating similar awareness programs and financial inclusion, financial awareness outreach events. Now, collaborating with other financial sector regulators, the Reserve Bank has assisted in the establishment of the National Center for Financial Education, NCFE, to bolster financial literacy efforts. With support of banks and NGOs, 2,421 Centers for Financial Literacy, that is CFL, have also been set up, covering almost all blocks in the country. This is an important initiative which has been undertaken by the Reserve Bank, and 2,421 centers have been opened, covering almost each and every block of the country. On the technology front, the Reserve Bank, as I just mentioned, has taken number of initiatives to facilitate development of digital public infrastructure and innovation. The UPI has revolutionized the digital space, digital payment space. Other initiatives like Regulatory Sandbox and the Reserve Bank Innovation Hub at Bangalore have fostered a robust environment for enriching our fintech ecosystem. The commencement of the Reserve Bank's pilot project for frictionless credit, that is end-to-end digital platform of Unified Lending Interface, ULI, as I mentioned a little while ago, is expected to revolutionize access to credit, especially for farmers and MSMEs. Now, the final aspect I would like to touch upon is expectations from the financial sector. Having spoken about safeguarding financial stability and financial inclusion, I would now like to highlight some specific areas where I believe the financial sector can contribute to India's growth aspirations. Now, I have been in all my address talking about issues of risk management, compliance, assurance functions, and the like, internal audit. But today I thought, while those points are important, and I do emphasize them, but I thought I will take out a little time to talk on some focus areas which is something which the financial sector consisting of banks and NBFCs need to focus on and these are the initiatives which can go a long way to contribute to India's growth aspirations. And in that, the first one I would like to highlight is improving female labor participation. India's female labor force participation remains lower than the global average. The gap underscores the urgent need for targeted initiatives such as improving girls' education, skill development, workplace safety, and addressing social barriers. This is for everyone who has a business. This is for policymakers, authorities, governments, as well as the major players in our business and industry and in our financial sectors. Having said that, I would like to say that entrepreneurship is a vital component of economic empowerment. Entrepreneurship is a vital component of economic empowerment. Yet in India, less than 1/5 of MSMEs are owned by women. Women entrepreneurs often face significant challenges, including limited access to capital, restrictive societal norms, and difficulties in accessing affordable finance. The financial sector has a crucial role to play in bridging this gender gap by implementing supportive policies, creating tailored financial products, and leveraging fintech innovations to offer better access to finance. This can be pursued on two fronts. One, by providing higher employment opportunities to women in financial institutions, and two, by supporting women entrepreneurs through government-sponsored schemes as well as banks' own schemes tailored to suit the businesses promoted by women. Banks could also actively explore onboarding larger number of women banking correspondents, that is BCs, and in some states they are known as bank sathis or sakhis, especially from among the SHG members. The next point, 2 points I have actually chosen to highlight are areas where the financial sector, particularly the banks and NBFCs, can contribute to our growth story. One, I said, improving female labor participation, including entrepreneurship, including encouragement and support to women entrepreneurs. I'm not saying that you do any I'm not asking that you dilute your lending standards, but within the lending standards, what I'm saying, the underwriting standards, don't dilute. I'm not asking for any dilution of underwriting standards. What I'm emphasizing is that within your parameters, within the underwriting standards the banks are expected and required to follow, there is considerable scope for tailoring products, for structuring loans, and offering finance in a manner to support businesses promoted by women entrepreneurs, businesses, howsoever big or mid-sized or small. The second aspect I would like to highlight is supporting the MSMEs. With our large young population, we need to fully tap the potential of MSMEs to drive employment and economic development. Despite their importance, many MSMEs remain small-sized and unable to scale up effectively due to various challenges, with access to affordable finance being one of the barriers. The financial sector may play an active role in supporting MSMEs. Banks and financial institutions may develop tailored financial products and services that cater specifically to the needs of the MSMEs. These tailored products and services would include offering flexible credit options, improving access to working capital, and providing financial support that accommodates the unique cash flow cycles and growth stages of MSMEs. Now, this can propel the MSMEs to expand, enhance their productivity, and contribute more significantly to job creation. Let me now conclude. The Indian economy is forging ahead with macroeconomic and financial stability and a favorable growth inflation balance. The policy mix pursued in the recent years has strengthened the underlying fundamentals of the economy and augmented the buffers. Consumption, which has been our main driver of growth, has picked up pace with recovery in rural demand. Investors' confidence is at an all-time high. Banks and corporates demonstrate robust balance sheets, and structural reforms are playing a big role in pushing forward our growth frontiers. We are living in a dynamic and uncertain world, and we need to remain vigilant and continue to build strong buffers. New opportunities are knocking at our doors, and when I look at the entrepreneurial zeal and the talent of our younger population, it makes me more confident of India's long-term growth prospects. Thank you. Namaskar.
Thank you so much, sir. It was a very insightful address, of course, touching upon various aspects of the economy and the strong and resilient foundation which the Indian economy has today, thanks to several efforts of reforms by the government and the regulator, and indeed, a lot of reforms that are going to be taking place, and the emphasis that the private sector and financial sector should lay on, in future for us to continue to remain robust and relevant in the global economy. Thanks for all your words. And you also talked about a lot of collaborations which are required for us to stay ahead of the curve. So thank you indeed, sir, for your address. Governor has kindly agreed to take 2 to 3 questions. So may I request if you could raise your hands, introduce yourselves, and just make a question. I think Adil, you have something?
Thank you, Governor. We always enjoy your speech at FIBAC. It's been many years now. Governor, in the same breath, you spoke about the structural push for physical infrastructure and digital public infrastructure. You launched the revolutionary unified lending interface in Bangalore recently. My question is, how do we ensure a level playing field wherein both regulated entities and registered fintechs can access and collaborate on ULI and such new DPI to scale ULI in the same way we have collaborated and scaled UPI?
You see, the ULI is in a pilot mode now. It has been in pilot mode for, last year we launched it. It has been in pilot mode. And already, I think some 16 banks have joined. We are now considering inclusion of other players also, NBFCs and others. So it's an open architecture. It's not a restricted field. It's not going to be an exclusive club where only some banks or some NBFCs will have access. Every player, every lender will have access to that. Every borrower will have access to that. But lenders, of course, before we give them access, they have to be necessarily regulated entities, because ultimately it is our responsibility to ensure that prudent lending is done. So it's an open architecture. The platform is going to be open for large number of players. And it's a kind of what you can say is that a play and plug model, in a play and plug system, in the sense that the platform is, which is under trial by the Reserve Bank. We will launch it, and we don't want to, as a regulator, we don't want to continuously, perennially run that platform. Like UPI, the thinking is eventually it has to be handed over to, to some players. UPI was handed over to the banks who are the shareholders. A similar approach will be taken in this case. So therefore, access it's not going to be a select club of a few players. It will be open to many more.
I think Ms. Kidwai.
So just given the country's commitment to sustainability and net zero in global forums as well, what advice, guidance do you have for the financial services sector in terms of pushing and ensuring this agenda for the country? The green finance.
In pushing and?
The green finance agenda for the financial services sector.
Now, in green finance, we have, last year we issued a discussion paper on green finance, and following that we have already started, together with the government, this green bonds is what we have done. We have also given advisories to banks with regard to managing the lending, which is sort of, that is the green related lending. So one is green finance, these green bonds which we have launched. We have now enabled green bonds also to be floated in the IFSC. And the key thing in that is to develop a taxonomy. I think that is one area where India has to have a formal taxonomy structure to sort of list out which are the lending, which are the green related lending which will be taken into account to treat them as green finance. And that also gives a lot of confidence to both domestic and international investors to put their money. And I am happy that in the last budget the government has announced formation of a group which will, and the government has announced an intention and a decision to move forward in this direction. So this is an area where we have made a beginning, and we are taking many, several other initiatives have been already taken by the Reserve Bank. It's on top of our agenda. And of course, we will have to work within the national priorities. And, we are not imposing any restrictions that you do not lend to this sector, or, we are not doing that. But at the same time, all that we are saying is that while you lend, take into account the climate-related risks also in your risk assessment. But from our side, we have no intention, because we have to operate within the national priorities, we have no intention of, issuing any advisory to the banks not to lend any particular sector or anything. In the priority sector lending, for example, we have restructured and we have included renewables in our, in the priority sector components also, especially for the small players. So, there's a series of steps being taken. And last year we came out with a, report on currency and finance, we call it. That is on climate finance, on greening Indian economy. I would encourage everyone to have a look at that report.
Hello, sir. Good morning. And thank you for the very insightful address. My name is Sulaja Firodia Motwani, and I head Kinetic Group, one of India's well-known automobile groups. I also head FICCI Maharashtra and FICCI's Electric Vehicle Committee. My question is sort of taking leaf ahead from what Naina ma'am just discussed and you kindly responded, which is for financing for electric vehicles. I think financial inclusion and green transition financing is at the heart of the future for the country and has been RBI's focus as well. But as far as electric vehicles go, which are very important towards reducing emissions in our country, they can reduce emissions by 33% in our country. Financing is not really available widely and at good rates. While many NBFCs have started financing electric vehicles, and therefore, it's available at a much higher rates, most of the leading banks are still kind of behind in financing for electric vehicles. So the sector has been requesting if electric vehicles can be considered in priority sector lending, like tractors have been and solar energy and other green energies have been. But electric vehicles and electric vehicle charging infrastructure creation can also be considered as priority sector lending, so that financing can be available widely and at good rates for the consumers and would really help towards the energy transition.
No, I have noted your point. You want inclusion in the PA, priority sector lending. 3 years ago, we did a comprehensive review of the priority sector lending, how it is operated. And we have brought about a number of changes, and the major changes including certain, certain additional components of renewable energy. We have also increased the monetary limits up to which the loans given by the banks will be treated as priority sector lending. And we have done also another interesting thing, not strictly relevant to your question, that the weight we give to to bank lending to various districts in the country. The weight also depends on you get more weight in the calculation of your compliance with priority sector requirements. You get greater weight if you lend to a district which is falling behind, and you get a less weightage if you go on lending to the same district over and over again. So number of changes we have brought about. The main challenge with regard to the priority sector lending is to ensure that the place doesn't get overcrowded, because it's the same pie for which there are lots of competing claims. I'm not saying that electric scooters or electric two-wheelers or four-wheelers are any less important. They are important. But that is something which has to be really examined going forward. And we have examined this, in fact, and there are two contradictory opinions which are coming up. And it's not my view. I'm just saying what we have got.
There is an argument that yes, it should be included. There is also equally an argument that the prices are also sometimes very high. So therefore, who's going to buy it? It's the people who can afford, they will buy it. So why should, be it included in priority sector? Because the priority sector is targeted towards the, the bottom of the pyramid. So we have not taken a call on this. This priority sector lending guidelines, it is, reviewed from time to time. We'll keep this in our mind going forward.
Thank you, sir. And would you recommend any representation from the industry with all the data points that might help? We'd be happy to put that together.
We don't need any representation to work, to decide. But yes, we would be interested to get the data points and all the points that you have in support of your argument. And we get requests actually from multiple sectors. So it becomes a real challenge for us to sort of, differentiate between sectors. But the key element we keep in our mind while deciding the priority sector lending is that the benefit of this lending should go to the lower rungs of the society.
Thank you, sir.
Thank you so much, sir, for taking some of these questions as well and responding to all the people who had asked the questions. I turn to Mr. Mehta for vote of thanks, and while he joins us, my word of thanks to him for the collaboration, wonderful collaboration FICCI and IB has had for many years now.
Thank you, Jyoti. I think we all the members of IBA and FICCI are indeed privileged to have Shri Shaktikant Das ji, Governor RBI, as our chief guest. We know his abilities to lead the difficult time has been demonstrated during the COVID time, and the second consecutive time he has been accepted as the best central banker of the world. I think this is a great privilege for us. The way he very nicely articulated between the growth, the inflation, financial stability, inclusion, and the way forward, his expectation from the industry is really a great understanding and learning for all of us, especially his analytical approach in informing the House that yes, the YOY growth of agriculture sector was 18% for the first quarter, and for MSME it was 14%. That shows that regulator is closely monitoring and the banking system is responding to the economic needs of the country, because agriculture and MSME are the drivers of the employment, and they in turn drives the consumption and will definitely help our goal of achieving the growth rate which is needed for converting the country into the Viksit Bharat. Thank you, sir, for sparing your valuable time and finding and giving us this opportunity to listen to you. And we really acknowledge that our RBI is not only the regulator, but an innovator also, because we have seen that in the past, the RBI has created institutions like NPCI with the support of the IBA when we have worked together. The NPCI was created. Now the next phase, because I was witness in the last global conference organized in Bangalore, and now the unified lending interface, which is going to revitalize the digital lending. So these initiatives supported by the institutions created by RBI, like IDRBT to support this innovation, to Innovation Hub to support the for collaboration with the FinTech, and a lot of such initiatives taken by RBI, which is really facilitating the customer delivery of the banking system. So thank you, sir, for all the initiatives taken by RBI, and especially your time for guiding us today. I'm thankful to the chairman, IBA, Mr. M.V. Rao, for spelling out the growth journey of the banking sector and the way forward for our contribution to the Viksit Bharat. We are really a great partner in our future endeavors, and thanks to the chairman FICCI, Anish Shah ji, for not only giving us the perspective of collaboration between the two institutions and the members together for our contributions into the Viksit Bharat. Thanks are due to BCG, our knowledge partner, presented by Naruchir Goyal ji, who very lucidly articulated their analysis, giving us a food for thought, what are the bottlenecks, telling us the opportunities and the challenges in the way forward. I'm thankful to the Chairman SBI for his unstinting support to IBA in doing these activities, and of course to Madam Jyotivich for always available for a great organizing event where the support of FICCI and IBA, we work together as a team for the benefit of our members. But without the presence of my members, without the presence of media, without the presence of all of you, this event would not have been successful. So thanks to all of you for being there, a patient listener, and definitely our today's deliberation will enrich us with a better sense of wisdom to contribute our might into the Viksit Bharat 2047. Thank you all for your presence here.